HECS in your home loan. Today we're going to talk about how the recent changes to the HECS scheme will impact your first mortgage application, your borrowing capacity, or even if you're looking to refinance or access additional borrowing. So what is it? So the HECS is a federal government program for Australian students who are looking to go to university and defer the payment of that course on a HECS or a higher education contribution scheme. That amount is added onto your account as a loan, and every year that amount is indexed annually, which is another term for the government applying an interest expense against your outstanding balance. So how does that work? So previously that indexation rate would be tied to the CPI, so the Consumer Price Index. There was some changes made going back to 1 June 2023, where the government has now said the amount of indexation that will apply will be the lower of the CPI or the wage price index. So we have come off a very high base of CPI. So annualized for the prior year 2023, it was 7.1%. And the government said because the wage price index at that time was 3.2%, they will defer to the lower amount, which means from that change for that year, it's saving HECS holders about $1 billion across the country. Additionally to that, there's been some new guidelines released by the federal government. So two things that came out from that recommendation. One is the exclusion of the debt amount from your DTI calculation. So what that means is debt to income, which is a calculation of your total debt outstanding on your application, be it the first loan or first property that you're trying to borrow for, or any existing debt. So other debts could be credit cards, car loans, things like that, plus your HECS, divided by as a fraction of the income on the application. So by excluding that from the DTI calculation, it's really making an immaterial difference. In fact, I worked it out, it changes on an average application from about 4.4 to a 4.2 DTI. So immaterial when it comes to a home loan application. The second change is asking the banks to take a short-term look at what's the outstanding obligation with the HECS debt. And what that means by that is it short-term? Could the borrower pay back that HECS for the next 12 months? And if that's the case, could the bank exclude that? Could the bank exclude that from the calculations in terms of working out what's the ongoing commitments for this borrower? And in this situation, APRA, who govern the banks and as part of the overall financial lending, they've come out and said that they don't think this is necessarily a great idea because there's not really a hard and fast rule around what is a short-term commitment. So I think a lot of banks, it's up to them to look at what that definition looks like. I think it's going to come down to, can that borrower repay that HECS debt in total within the next 12 months? Because that would be a short-term commitment. And if that's the case, they can exclude this, or have the ability to exclude this from the application. In terms of who's in that position, again, this is going to be a very, very small amount of borrowers out there if you think about it, because it needs to be, for this to have a material impact on your borrowing capacity, you need to have a higher taxable income and a low HECS debt at the time of application. So if I look at my clients, those with higher incomes generally have a substantial HECS debt that's not going to be paid off within the 12 months. And then those clients that do have a small HECS debt, it's often worthwhile to look at and say, okay, how much of that, what do we actually need to pay off now versus can we pay that off, 12, 18 months? And quite often the conversation is really, let's pay off the HECS in total now, get that done with, and then allow us to unlock some of that borrowing capacity on the application. And what's really important to understand is that's not going to have a massive impact on, in terms of your home loan repayments, it's not going to have a big impact if you have your HECS paid off or if it's include or exclude on the application. But what that means is for the borrower, if you've paid out that HECS, let's say today, and we've gone ahead with the application, you can go back to your payroll, update them at that point, and say that, okay, the HECS is no longer a liability we need to withhold for, and you will get that money back straight away on your weekly, fortnightly, monthly pay coming through from payroll because less tax is withheld. more in your bank account. That allows a bit more flexibility in terms of your cash flow. You can put that into the offset account of your home loan and not have to worry about the HECS, which is typically closed out at submission of your tax return, which can be, depending on the time of year, can be the end of the financial year, plus when you lodge that tax return, plus some working weeks to actually have the ATO process your tax return and allocate the withholding from your tax for the HECS throughout the year and allocate that against your HECS balance. So it can take some time for it to work through. So again, I don't think this change that's been announced by the government is going to do much more than just window dress that they're looking at this problem, which is younger borrowers are coming out with higher HECS debts, and it is a big speed hump towards home ownership. And so finally, can I refinance with a HECS debt? Of course you can, definitely. That's not stopping people. It just needs to be factored as an ongoing commitment. And as we said earlier, you can look at, potentially releasing some equity if you had some growth in the property, cashing that out, paying down some of the HECS if you need to. We just need to bear in mind the tax implications of that and work our way through that. But that would open up your borrowing capacity for the future. If you have any questions around your HECS and your home loan, please reach out to us. Thank you.